Welcome to the Weekend Report. This weekend we're going to start something new where we're going to look at a wide variety of indicators and charts that I use to assess the current state of the market and risk and potential within the market before going to some weekly and daily charts. So without any further ado, let's get started. Here we're looking at the daily chart of copper. Copper is often called Dr. Copper as it seems to have a PhD in economics for predicting economic growth. So it is often used by stock market analysts to figure out where the economy is headed. By that point of view, things are pretty good right now with respect to the economy. We see down in 2016, copper made a bottom just above 2 or so. And since that time, it has been moving steadily up, going up approximately 50%. And as we often do, we're looking at a 150-day moving average, which gives you a long-term trend. This is denoted in blue. And we can see that copper has been maintaining its position above this line, suggesting an uptrend. Another indicator of market risk is the VIX, which we won't get into the details, but it is often called the fear indicator, and it is a measure of volatility. Readings below 20 are generally considered low, though we have been in a very low volatility state for many years now that is quite unusual and historic. We can see that we had a recent spike in volatility several days back here, but since that time the volatility gauge has fallen off, suggesting that risk is diminishing within the market. Now, the other thing you can remain concerned about is sometimes when the volatility gauge gets down below 10 recently, it has been a sign of complacency. But I think the most accurate picture right now is that risk has diminished over the last several days as the market recovered. Now, looking at the S&P 500 itself, on a daily time frame, there really isn't anything particularly bearish about this chart. We see this is the last priced action yesterday on Friday. We are well above the short-term 20-day moving average, the medium-term 50-day moving average, and the longer-term 200-day moving average here in green. We see a clear uptrend. One thing I would say provides some element of caution is that if you drew a line connecting these tops here from each peak, you see that we're somewhat extended along this line. This somewhat may explain the sell-off earlier in the week. The other aspect of this chart that raises some concern is you can see on a regular basis the stock market, even in an uptrend, will retest the 20-day moving average, will retest the 20-day moving average, will retest the 20-day moving average. Similarly, we'll retest the 50-day moving average, we'll retest the 50-day moving average again before heading higher. One could say perhaps this was a retest of the 50-day moving average, but we are well extended above this medium-term moving average, and at some point we will correct back a bit. Even more so from a longer-term perspective, it is not uncommon during an uptrend to retest the 200-day moving average. And you can see here the 200-day moving average in green and where we are here. And we've really been extended above this line for a significant period of time, and we're well above it, suggesting an overbought state. So that doesn't mean you go and sell. It's just something to be aware of, where at some point a significant correction could occur even within a large uptrend. And this sell-off could be easily 200 S&P points here before you even get down to the 200-day moving average, and then we see a critical test then of the longer-term trend. but there really isn't much sign of that at this point. Some selling volume did come in here, but you can see we spiked down, touched the 20-day moving average here, and finished higher. We sort of came back and retested here and headed higher again. So I think unless we break this level, there's not any immediate concern of that sort of pullback to the longer-term moving averages. We use a wide assortment of technical indicators to help us understand how the market is doing and the health of the underlying market breadth. None of these give especially buy and sell signals, but rather it's the body of evidence that help drives our position on the marketplace. One of our favorites is the bullish percent index, which one can view in a sense as a derivative of the advancing and declining issues. Obviously, in a strong market, we want to see more stocks going up than going down, and sometimes this can break down under the surface before the actual price action does. We particularly like to look at the bullish percent index relative to a 32-day exponential moving average. And we like it better when we see a break above that moving average, which is depicted here in blue. We can see that since September, we have largely stayed above this blue line, although testing it in November, and this has been a fairly healthy period for stocks. So this was a good time to have significant risk on in combination with good market price action. The health of the market underneath the surface price should be considered good during this time period, and we remain above this line as of today. Now, another measure of market breadth we like to use is the New York Stock Exchange Ratio Summation Index. Again, we're not going to get into the details of this indicator, but it again is a derivative, one can say, of the advancing and declining issues. Several things that are important to look at with respect to this indicator. First of all, just simply, is it above the zero line? Generally, a healthy market will be above the zero line. We can also use this indicator as a measure of being overbought or oversold. One can see in particular just before the election last year, we dipped down below zero and then quickly regained our footing going above zero. And this, along with many other technical indicators, give you a very clear sign to be bullish and to put on additional risk. So with respect to where we are right now, we are perhaps getting a little bit overbought here up near 500 on this indicator, but we can see we've gone well above this previously before turning back down. And I think, again, the market from an advanced decline perspective is healthy. Now, there are some sectors of the economy that generally, if the stock market is going to go up long term, need to remain healthy. One of these is certainly the financial sector, which now comprises a huge percentage of the S&P 500. And we can see that since this dip down in September, after a period of consolidation, financials have made a strong move higher, which has coincided with optimism, an increasing interest rate, and also the potential tax cuts that seemingly are going to pass through the legislative branch and be signed by President Trump. Now, I would say if one looks here at the price action just a few days back within this index, some significant buying volume coming here that might suggest a buying climax. The fact that we're well extended now above the 20-day, the 50-day, and the 200-day moving average, it would not surprise me if this sector pulls back a touch, which may even coincide somewhat with the market itself pulling back in the not too distant future. I think the thing to keep in mind, though, is we are in a very seasonably favorable month, and while that doesn't always translate into gains for the month of December, that is the better bet generally. Now, the last few weeks have seen a significant sell-off in tech. This has been seen in the semiconductor index, which is another potential leading indicator for technology. But as we've seen with charts that have declined recently, there's nothing to suggest that the uptrend in the semiconductors is over. We see an upsloping 200-day moving average, and stocks remain safely well above it, although one might expect a retest in the future. One of the oldest and most well-known markers for a healthy market is Dow theory. And basically, the underlying theory is that the transport sector must also be advancing nicely while the remainder of the market is, to suggest a persistent and healthy stock market. We see here no signs of particular trouble in this chart. Again, above all three short, medium, and long-term moving averages. The only thing, again, I would say is there was somewhat of a vertical move here on significant volume, and it would not be surprising if we see a pause here. So let's go ahead and take a look at a nice big watch list, both in the weekly and daily time frames, and see if we can find some candidates that we find possibly amenable to long or short positions for that matter. Right at the top of our list, beginning with the letter A, is Apple. And we can see several things within this chart. We saw a nice retest of the long-term uptrend here on the weekly chart, and then quite a nice move there from the 100 level in late 2016 to present. And this trend really remains intact. We see a nice trend line that you could draw from here to here to here, and we remain nicely above that. Now, if anything, the only thing we could be concerned about here is we see sort of from this peak to this peak to this peak, a decline in the amount that each thrust upwards is not as much of a distance as we see in the move before. So we see a nice long move in this first wave up, a sort of medium move up from here, and then this move so far is kind of stalled. The other thing that suggests perhaps some risk of this move at least consolidating for a while would be on RSI 14, which is a measure of overbought or oversoldness. We can see the peak on this was higher than this peak and this peak, suggesting again that momentum has stalled. So we do think there is some risk for Apple potentially to chop around in here a bit before taking a serious challenge at 200. Again, since Apple tends to correlate well with the stock market, if the market aggressively moves up, all bets may be off on that consolidation, but certainly nothing overtly bearish in this chart. Here's the weekly chart of Amazon, and we could almost predict where this move was going to stall just by drawing a line from this peak to this peak to this peak, and lo and behold, the move up that started in the fall has stopped right around the 1200 level. Now, as we've said with other stocks, nothing overtly bearish. This stock is in a long-term uptrend. If we draw a line from this trough to this trough, we can see a potential place where this move might consolidate a bit and come to rest here. I will say that there was significant selling volume this week, but really no downward progress with some high finishes here, suggesting that the sellers were not winning, at least for now. Now, you may hear my 4-year-old talking in the background during this recording. He is a very interested stock market trader, and he's also eating his lunch, but we will continue with our weekly review despite perhaps hearing him here and there. Air Products and Chemicals is a nice company, and we see sort of a similar pattern to the chart that we saw with Amazon, where if we draw a top trend line for this uptrend, we kind of came and banged up against it and have stalled here. Alibaba is an Amazon-like Goliath company in China and one of our favorite tech stocks. This stock had some significant volatility this week. You can kind of predict with any stock that when you get near an even number, such as 100, you're going to pull back and stall. So here again, when we got near 200, the stock almost immediately pulled back and in a very aggressive fashion. The move on Thursday was particularly concerning. We can see the volume bar from that day in red was rather high relative to prior volume bars, although there have been some bigger spikes here and there. And the finish, which you can perhaps just barely see, which would be represented by the notch at the bottom of this red bar, was down near the bottom of the bar and at the close of the day. So that on high volume is a big warning sign. Now that being said, look at the move through 2017 on this stock. We have never come back and even tested the 20-week moving average, staying well above this blue line. This has been almost a continual rise up from 80 all the way almost to 200. So a pullback was indeed inevitable. Now, one reason for hope here in terms of the stock holding and potentially challenging 200 would be the volume that we saw on Friday, which was even higher than the day before where we had that red bar, and then the close denoted by this blue notch that you can just barely see here was right at the top of the day. So I think the jury's out on whether we go lower. We certainly could go lower and the trend would remain intact. It would not surprise me to give up another 10 or 20 points just to blow off some steam. But on the other hand, if we see good follow through after Friday with an open, say, above the 180 level on Monday or Tuesday, and then clear this area, this stock could make another run. So I don't think there's any action you want to take on Alibaba here, whether you hold the stock or whether you're looking to sell. But you should watch carefully the first few days of the week to get a clue as to its next move. BHP Billiton is a mining company and can be viewed in some senses as a proxy for global growth. We can see that in 2016 it made a bottom and has been in an uptrend. These sort of commodity stocks are not for the faint of heart to trade, as they are extremely volatile and frankly for that reason not our preferred stocks to make risk-reward decisions with, though I certainly think there is some value in a diversified portfolio for them, as many pay dividends. But we can see that the stock has moved up nicely since July, predictably in a period of consolidation, but the uptrend is well intact, suggesting, as we can see from many economic indicators for the moment, that the world economy is doing better. Celgene is a company within the biotech industry, and I think well illustrates the last few weeks the risks of playing in this sector where you can have very rapid gains that are very nice, but you can have a chart that appears quite good and be feeling quite well about your gains over a prior few week period, and then suddenly have them all taken away from you just in a period of 1 to 3 weeks, which is exactly what we see here with Celgene since the beginning of the fall. We see this nice move up from the spring summer, and within just a few weeks this was taken away. Now the one thing I would say, being that we are Wyckoff stock chart analysis and place a huge emphasis on the volume in association with price movement as opposed to people who go solely on momentum. Look at this spike for this week in terms of the volume on this stock. This could have the potential to be a climactic end to this move, which was significant, down from near the 150 level to well below 100. So this has been a huge hit on this stock, and now we see a bit of a pause. Bottoms are very difficult to call, especially V-shaped bottoms. And I would never suggest that a stock trader look for that kind of bottom. We would generally prefer to see a significant period of consolidation after a high volume move down like this, and then hope to see some recovery in the stock and the volume on the buy side start to pick up in a way that is more obvious to gain entry at a good price. But sometimes a stock like this will shoot right back up, and if you miss it, as we like to say, the buffet is always on. And you can always refill your tray up with some food elsewhere. Clorox is obviously a well-known home products company. This is kind of a neat chart, although you could be a little late to the game, at least on the weekly chart. What we see here is a real nice move from the fall of 2016 from about 110 to 135. And then predictably, after such a big move, there was a long period of chop during essentially almost half the year. And then there were some clues as we had this move down. We saw a spring of this low where people who had placed their stops here got taken out by the smart money. And then you see all this buying volume come in right here. So low taken out, stops hit, smart money buying from, say, the dumber money, and you see this huge spike in buying volume, and the stock takes off and breaks out to a new high here. I think this move has some legs. The question is, it would be nice to see a pullback and a retest of this breakout level, which frequently but not always happens, rather than trying to chase it after such a big move almost uninterrupted for the past several weeks, with the stock moving up on a household product stock $15. So this is one to definitely put in your wheelhouse and on your watch list, and to look more closely, say, in shorter time frames such as the daily, to see if you can find an opportunity to gain entry. But it is hard to do here at this particular moment on the weekly chart. The better play would have been looking at this spring level, the buying volume coming in right here. Somewhere in here was your opportunity to get this move to this point. In Cisco on the weekly chart, we see a pattern that we've observed in several charts earlier. Here's sort of this upper portion of the uptrend channel. You could draw the lower channel here, and we see that we've kind of banged up against it. RSI in green is overbought, and I would wait after such a nice move from 30 to 38 for a pullback here. It may go significantly higher. It could go to 44, but generally when you're trading, you're thinking about risk reward. You had this little pullback here as an opportunity perhaps to get in on the breakout as it retested the level it broke through, but we're well past that now. So I think to gain a good entry into this stock, you want to see it sort of chop, consolidate, pull back a little bit, at least to say this lower trend line that we would draw here, and then you might have a nice opportunity. Chevron on the weekly has somewhat of a similar pattern, and clearly Chevron will be tied in well to the commodity oil and oil prices, but I think the opportunity might be a little better, though I didn't like the finish of this past week in the lower portion of the weekly bar. But nonetheless, you see a breakout to a new high. We pulled back into that range, and now we're trying to break out here. I think this might have some room to run. You see only 1 week of selling in the last few weeks. that didn't really take you too far down and was just a retest, and then we've broken back out on significant volume. So this weekly chart does appear promising, though I'd like to see us break back, say, above this 123 level on this bar that isn't healthy looking. Now, Disney had kind of been taken out to the woodshed in 2016. We can see it up here, and then going into the fall around the election of 2016, coming down all the way into the 90s, the low 90s for that matter, with a very aggressive move back up before again declining. Disney, from a fundamental standpoint, is hard to know where it's headed. Its ESPN property is being questioned on many levels as to its persistent value, as the entire model of delivery of media is being changed. But certainly Disney, from a variety of standpoints in terms of the quality of its overall portfolio of products, remains an attractive stock. What's kind of surprising about Disney is the degree of volatility we see frequently, several times a year over the last couple of years. This big move down of almost 30 points, a move here, a move down. This move that was really impressive again of a good 20 plus points. This move down here, and then we're headed up again. I do like the appearance of this chart, but again, there's been a fairly aggressive move up. There's this red bar here, and although you can't see it, the close here was not favorable. So Disney moved up significantly this past week before finishing down near the end of the bar. I would like to see this chop a little bit, and then I do think a position might be warranted. Dr. Pepper Snapple has sort of a similar appearance to that of Disney, although a much better finish this week with the notch up here more towards the high end of this weekly bar. Again, a fairly aggressive move over the last several weeks, but the stock is not extended on weekly RSI, and I think this is one where you can look for an opportunity on the daily chart to gain entry this week. This is the emerging market exchange traded fund. Emerging markets are extremely volatile, often correlate well with the commodity stocks and commodities themselves. They are very hard to trade due to that volatility, which can change. The situation in one of these stocks or these countries can change over a very short period of time. We have seen emerging markets in a significant uptrend since late October. A nice finish here after some selling came in 2 weeks ago. We sold off earlier in the week, this past week, and then finished up near the top after a retest of this sort of trend line up. So there may be an opportunity to get back in here and ride this further if you have the risk tolerance. EFA is an exchange-traded fund for global stocks. Again, we see evidence of a relatively improving global economy, an uptrend. This stock I've found, or exchange-traded fund, I found somewhat difficult to trade on a very short-term basis, but certainly on a longer-term basis, we see that it is in an uptrend. Definitely overbought, but after a period of consolidation, it might be a better medium to longer term purchase. Now looking at the weekly chart for Facebook, which is one of our favorite trading vehicles, we see the stock has been in a very nice uptrend over this longer time period. We can see that a nice uptrend trend channel line can be drawn here, the upper border of this channel, and that we repeatedly strike against it. We saw some selling come in 2 weeks ago with a poor finish, but again this week, volume came in. The stock was pushed down initially, but look at the notch here that you can just see to the right, and we finished right up near 180. So I am liking that price action quite a bit if we can open the week or get above this bar at some point and hold it for a day early on this week. I think we could make a run at 200. Now, things that would be concerning would be the degree to which it's overbought, although it did sell off here. But I kind of like the appearance of this chart, at least on the weekly time frame, and think if you see that price action move into the mid 180s, you want to grab on for a ride. And it'd be very easy to place your stop, say below this, just below this bar, and that represents a decent risk reward with, say, nearly 20 points to the upside and just maybe 10, 11 points to the downside. So 2-to-1 risk reward to risk is quite good. Now, looking at the chart, the weekly chart of FireEye, which is a cybersecurity firm, I have been frustrated by FireEye, as well as another stock we'll review later, Palo Alto Networks, because it just seems in this age of cybersecurity and all the news, even politically attached to it recently, that these stocks would be getting taken along for a ride upward, but this really hasn't happened. These stocks are extremely difficult to trade and can have huge moves through earnings. You have to be very careful if you're trading them to be aware that if you have a significant gain going to earnings, you're either looking at a wipeout of that gain, or the stock may move up significantly and you have to make a decision before earnings occur as to whether you can stomach that. Now, this stock did look like in early 2017 we'd made a bottom. We'd recovered really nicely. This was a big move up. This was about $11 and we went to 18. But some selling volume came in here, low finish here, and really no buying has come in. So this is not the point to step in and take the risk here. First Solar is a company involved in solar energy, as you might imagine, and there's some really nice elements to this chart. We see a down move in 2016 into spring of 2017, followed by this move up. And there really were some nice clues of a developing bottom and then a recovery. We see the massive volume in red here with these spikes for several weeks. Again, here even more so. You could have been tricked here that this was the end, but you really didn't see the kind of buying volume come in that would suggest to come in. And then you start to see this spike in gray buying volume, and then this spike, and even less selling volume. You can see just the selling volume, the red volume bars diminish. This was a really nice move and a change in behavior where the buying volume started to overwhelm the selling volume. And this stock moved up absolutely tremendously. We still like the appearance of this chart. You see this nice consolidation again after a nice move here. It moves up to here, we consolidate again, and this may be ready to go. So you see this volume here where we break out of consolidation. And this was such an explosive move in just a week. We consolidate again, and then we explode on volume again here with a high finish. This is a tough stock to grab onto right here. It made a monster move this week. I would prefer to see some consolidation before considering buying this stock. And again, you have to be very aware this can move significantly on earnings. You need to be aware of when earnings are for this stock, and it is not to be taken lightly in terms of its risk. We've discussed General Electric here and there. This has been a very sad story where one of the great American companies and stocks has really taken a beating during 2017. We saw this consolidation here over the course of 2016. And then the stock has just been a horror show, declining almost $13 or so in a period of a year, taking over 30% of the value of the company down with it. Now, we've sort of reviewed that this is a stock you want to look for the evidence of a bottom. We thought we might be getting it here back this week when we saw this spike in volume, but we again cautioned just because you see evidence of a forming bottom, you do not necessarily want to go in until you see evidence that there are buyers, which really didn't happen here. You don't see any major spike in buying volume. Maybe there you did. And what we said at the time was, that's fine, but you need to see the price action clear this bar and hold, which it didn't happen. And that was simply a fake out, and selling volume overwhelmed buying again. And there is just absolutely no evidence of buying here. Now, this again is the highest selling volume bar for a week in the last 2 years. So is this the bottom? Maybe, but we're not here to guess, and you don't need to guess as a trader. Trading is not about guessing. So we're going to look and wait until we see evidence of significant buying volume coming in. Often after a move like this stock could consolidate at a given level for a year or two before we see buying. Or, alternatively, G's just a dead stock and a dead company, and it's on its way to even lower levels. But we're going to wait until we see evidence to tell you what we think is going to happen next. But there's definitely some evidence of climactic selling here, down after a big move. And the sentiment on this stock is certainly so low and so horrible that the contrarian says you do want to look for an opportunity here. Gilead Sciences is in many ways a great company whose stock has had a very hard time over the last year and a half or so. We see that the price here around 100 in mid-2016, only to drop down into the mid-60s. There's been a nice recovery in this stock since the summer, but you can see this has been super volatile of a move with a return down to the 70s. Some evidence of buying 2 weeks ago, and here we are. We like this stock a lot. I think you need to look for more evidence of buying in the weekly time frame to consider a longer term hold here. And I do not think the buying opportunity has arisen yet on this stock. GLD is the exchange traded fund for gold, and it is a good indicator for the commodity itself, as it is basically a way to essentially buy the commodity gold for retail investors. This is a very, very difficult asset class to trade. Again, the commodity space, and it's not something we recommend, but since people tend to look at the price of gold, we thought we'd at least take a look here. You see this apparent recovery down in 2016, all the way where the price went from essentially 100 to 130. A very nice 30% move, only to take the elevator straight back down to just above the 105 level. It has been slowly recovering in a very stutter step fashion with tons of volatility since that time. There's been some selling volume that's come in with very little evidence of buying here, and right now gold looks weak. The chart of Google has somewhat of a similar appearance to that which we've seen on other tech stocks. You see, if you draw a line from this peak to this peak to here, we're sort of coming up where it banged off this upper channel trend line and pulled back on significant volume with a poor finish. If you can just see that notch there, that was in the prior week. And then this past week, we again see a similar pattern to that which we've seen with tech stocks, where it looked like this was going to be a much deeper decline, only to finish higher than at the earlier part of the week on some significant volume. So Google's a great stock. It's been in a somewhat of a consolidation here since this move up from the low 900s. We would have expected that. And I think if it opens up higher here or closes at some point in the next few days above this 1050 level, this may represent a good entry point. Otherwise, you could see some chop around until it sort of catches up with the lower aspect of the uptrend channel. GoPro has been a dead stock for a long time. We often use it to illustrate a stock bubble, as there were many characteristic elements when the stock got up into the 80s, 90s level several years back. Really hard here to say that the bottom has been put in, though there has been a significant period of consolidation, albeit with a large range that makes it very hard to play. The range being $7, $8 on a stock that has continually been below $20 for almost 2 years now. The price action here is rather ugly, with very little buying volume coming in. It looked like there might be something here, and perhaps that's still true, though there's no evidence of it at this point. But you saw some of the biggest volume in a year come in here, and only to have this move fail, which I think illustrates a key point. A stock that is in a downtrend should be considered to have bearish outcomes anytime you are at a point of making a decision, and it should be stayed away from the long side unless you see very significant evidence that the trend is going to change. So within these periods of consolidation, your best bet is generally to bet down on a stock that is heading down already. This is a chart for Hershey, and we see some nice elements to this chart here. You see this low here, the stock starts to move back up within an uptrend that has been established, and then this very scary weekly bar here where it takes out this level where probably many people had left their stops, and we finished above that level. Buying volume comes in, there's very feathers weight, as Wyckoff used to talk about it, of selling here in this one bar 3 weeks ago, and we continue upward. This is a nice looking chart. We are not overbought on RSI 14. Buying volume has clearly come into this point. The stock is in an uptrend. While the move here has been somewhat aggressive and you might want to scale in, this is a nice looking chart as long as we remain above this level here. IEF is the exchange traded fund for medium-term treasury bonds. People often think of bonds as the safe portion of their portfolio, but I will tell you with respect to trading, bonds are extremely volatile and very difficult to trade, probably because people say that on Wall Street this is where the smart money traders are. So we don't tend to trade bond shares, bond futures, or the exchange traded funds themselves, though we do look at the trends within bonds to figure out the level of risk tolerance for stocks, as bonds are typically viewed as a place for safety, and you will often see bond yields go down with corresponding prices of bonds going up at the point that there is felt to be significant risk in the market. For example, here in terms of figuring out how bonds might tell you something about the stock market, we can see this steep decline in the fall of 2016 for the bond ETF, IEF. Well, what does that correlate to? We see right around the November election that as stocks took off, bond prices declined rapidly, suggesting risk on in stocks. Now, what's interesting, since that time, and for most of 2017, we've seen some recovery in the price of bonds. That is until the fall of this year, where things have sort of declined again and yields have gone back up. To remind you, bond yields and bond prices are inversely related. For the moment, the long-term trend line on bonds still suggests that the move is intact for this 30-year bond bull market. But we are certainly entering a period where that is coming into question. There's not any buying here going on here, and we should keep a close look at this and the longer-term dated Treasury ETFs and futures. Now, looking at Intel, we can see some nice teaching points on this chart, though I think the opportunity to buy this at a nice level has certainly passed us for now. We see since late 2016 this nice period of consolidation that went not quite a year, where the stock was between the $32 and $37 range. The hint here that we were going to break out of this range was this big chunk of buying here with these volume bars here, and then on this pullback, although there was some selling volume of significance, we really didn't go very far, and then we started to break out on volume. There was your chance to get into this, say at about 36 or so, and catch an $11 move, well over 25%. I'm not doing the percentages in my head right now. It might even be more than that. I'm actually not terrible at math. But this move's dead vertical since September or so. Dead vertical moves typically end with at least a 50% retracement, if not a decline all the way back to where they broke out. We did post a video about Bitcoin earlier in the week or so. And although we're not generally going to talk about Bitcoin much because it's not specifically a stock, we thought it was an example of a chart that is going bubblicious and represented some good teaching points. I don't think for an $11 move here is particularly a bubble, but it is certainly a move in which people are going to want to cash out some profits. It seems like that is happening here. Now, this could be a little bit of a flag pattern. You could get it to take off that way. For my money, you see this sort of climactic volume here that's the highest volume on the 2-year chart. You see selling coming in, no buying here. I'm not going to try to chase that here, and I'm going to hope for a pullback and a consolidation here, with then an opportunity to buy what is a very good company. IYR is the exchange traded fund for real estate investment trusts. These are very nice vehicles with respect to a very large dividend that they typically pay, as you're basically being paid a portion of the rent that these real estate companies receive. The exchange traded fund is quite frequently volatile and very difficult to trade. You can see just in a few weeks, up, down, up, down, up, down, and then even tighter here. It's certainly not something that we like to play other than from a longer term perspective. Is it in an uptrend, and should we hold it to receive the dividend? Which certainly there's nothing to suggest in this chart, despite the rise in interest rates, that we should be selling at this point. Here's the chart for Johnson & Johnson, another great American company. There's actually a lot of things to like in this chart. We see from the spring-summer a period of consolidation after a very aggressive move up from the low hundreds into the 130s, and then a predictable chop catching up to this 20-week moving average. It looks like it's going to go lower here and then suddenly reverses back, having shaken people out. Buying volume comes in, and we break out above these two areas of prior high, 3 even here, 1, 2, and 3. So we break out there, and then exactly what we've been talking about with some of the other charts happens. We get a pullback to retest this breakout, a higher finish here on this bar, and then buying volume coming in. So at least on the weekly chart, this looks like a good opportunity right here. And you could simply place your stop down below this 135 level for a fairly high reward to risk ratio, because I think this could probably go into the 150 area or so before you'd hit this trend line, maybe a touch higher, and then you've only got $5 or $6 to the downside. So this would be a chart to take a look at the daily and other time frames to see if you can find a good entry. Again, what we like to see is that the stock price in the next week, or in any time frame for that matter, when you think you have an entry point, we like to see at least the open, if not a close, occur above the high of the preceding bar. So that would be in the low 140s or so. This is the chart for JP Morgan. We talked about how the financials have moved up nicely recently, suggesting good things for the stock market. We see some classic elements to this chart that we talked about. Some consolidation here, a breakout above, a retest, and then 2 weeks ago, a nice move here with a predicted little stalling here. Nothing overly bearish in this week's price action, though we did finish a little lower. My preference would be to have this consolidate for another week or 2 or 3. Sorry about that inadvertent click. Let the moving average kind of catch up to this and then look for some buying volume to come in, and then I think this has some room to go. Again, sort of blow off a little bit of steam here from an overbought condition. From a somewhat alternative point of view, you could buy the stock right here, hoping to trade in a longer time frame of many weeks to months, where you place your stop here down around 95 and look for this trend to continue significantly, say to maybe the 125 area or so. But again, we generally like to see some sort of consolidation pullback like we did here, and then evidence of a breakout to the top, or to that top, I should say, and that would have been a better entry point there. Coke is another example of how the consumer staples, which are generally thought to be less volatile, are much easier to hold than trade because they do have some very small term or short term volatility that is hard to play. You can see all these little micro moves within this sort of up, down, up, down. There was a nice move here, but up, down. The cycles on these stocks are fairly short. We see some evidence of trouble here with this big high volume area here, very wide ranging bar with a poor finish, an effort to rally on high volume that really goes nowhere, and then we tried to sell down here. The only thing I could say bullish from this perspective is that the selling volume really hasn't taken it down any lower yet, but I don't see anything in this chart that tells me to buy the stock here per se, and would like to see it blow off a little more steam and perhaps even come back and retest this longer term trend line. So here's the chart on Lockheed Martin, which is an aerospace defense firm. Now this chart has some elements that we like. You see this stock has come back several times to test the longer term 20-week moving average here, here, here. And then again, just a few weeks ago, we could consider this a retest, but really no downward progress after that, and the stock slowly creeping higher. The finish on this week's bar was at the top of the range. And again, I think if you could find a bar early in this week that closes above that 315 and change area, say 316, then you have a pretty nice trade, I think, with, if you look at the trend channel going here, a good shot to even finish above 340. You could either use this 20-week moving average as your trailing stop, or you could simply allow for a little more volatility and place your stop below this big weekly bar from early October down in the low 300s. This is the chart for McDonald's. which really looked like it was heading towards trouble back in 2016, and then again a pattern we've seen with many stocks. This stock has just gone on a tremendous run since the election, from the low hundreds now up around the 170s. Very overbought. I find a very difficult situation here to consider going in here long, even though there's no reason to think the stock won't go higher. You did finally get this opportunity down around 150 with some chop. The stock in what we would call an absorptive phase, sort of creeping up with the buyers absorbing the sellers, a retest here of the longer term 20-week moving average. And then when some buying came in here and you cleared this area, this was perhaps in the low 160s your chance to jump back in with a fairly low risk medium term trade. I just don't see it here. This stock, if you draw a line here, from here to here, and even here is extended. It may go to 200, but I can't see a good technical reason why I would jump in right here and think the risk is too high. The pharmaceutical area has been very difficult to trade and even own through the election cycle and with President Trump. Certainly there is a lot of conversation about the exorbitant prices Americans pay for drug prices relative to their peers in other countries such as Canada and Europe, and justifiably so. On the Merck chart, we see some fairly scary things over the past 6 to 8 weeks, which this is just a tremendous amount of selling volume here, highlighted by this big, huge down bar in October with a very poor finish noted by this notch on the right. Now, we really haven't progressed since, although you would expect after this breakdown to at least come back and retest this gap, and perhaps even more so to retest this area where it broke down from. Though you could also view this as the breakdown point. I think if you see more selling volume come in and a breakthrough here, it might be more appropriate to short this stock, but I certainly see nothing that tells you to go long at this point on the chart. The Microsoft chart shows us some nice teaching points again. Here we see a period of consolidation, late 2015 all the way well into 2016. We see this low here. We see some selling volume come in here. The price of the stock is moved down to the bottom of this bar, which springs this area, shaking out people who may have placed their stops below here. And then the real move and breakout occurs. From this breakout, we see a retest of this high area, some absorption here where buyers are basically absorbing sellers, and then volume comes in again. This was sort of the area where there was a really clear chart picture that this period of consolidation, of an absorption level on top and buying volume come in, this stock was ready for prime time and quite an extensive move of $30 in just about a year's time. So what we've seen recently is the stock is certainly extended as suggested by RSI 14. We see this nice move here on volume, some consolidation. Now for the bulls, there's certainly hope. We saw a lot of selling volume come in as we did with other tech stocks earlier this week, but look where the finish was denoted by this right notch here on the bar, right up near the top of this. You could potentially take a trade if you have a close up above this 85 or so area and simply place your stop down around the 81 area and see if you can get on for the ride. A potential more likely scenario would be that we chop around here for a while and we see it catch up a bit to this moving average before the next move is clear. On the Netflix chart, we see another example of the even number phenomenon. We had spoken many weeks back that we thought this stock was headed around the 200 level and would likely stall or fail there. That's indeed what has happened during the fall. At this point, the price action has been quite volatile, with the stock dropping over $20 at one point. I do like the finish this week towards the higher end of this bar, and I think you need to watch very carefully over the next several days to several weeks whether we can start to make a push back towards 200. I do not see a reason to buy here. I would not be in a hurry to buy even on a retest of 200 unless I saw many elements to suggest to me that this time we were going to clear that level, and would in fact prefer to see a breakout above 200 on volume, at which point, having tested the longer term trend line here, this would be a screaming buy. Novartis is another pharmaceutical stock that has seen recent volatility. Had a nice move up in 2017, earlier part of the year, and then we've seen this sort of consolidation and chop. Don't see anything at the moment that tells me that this is a buy. We did see some significant volume come in October, but so far there's been no follow through to the downside. A break below this area would certainly be bearish, and then a lot of people who had tried to sell short here would be losers on the other hand if we broke out above here. So this is one that warrants watching, but there is no clear action defined by the volume and price action at this point. O is a great dividend-paying real estate investment trust that has provided steady income to investors for decades. As I mentioned earlier in this video, I find the REITs very difficult to trade. I prefer to hold them for longer periods where I can attain income from them, but we certainly look for longer-term trends, as if you held these during the financial crisis, a significant portion of your equity position was damaged. So over the last few weeks, we've seen some selling volume come in, but really no significant progress here. You're kind of stuck in this chop range that has occurred since this significant down move in summer into fall of 2016, and you're sort of in no man's land right here. And I don't see a play on this right now on the weekly chart. Omega Healthcare Investors is another real estate investment trust, this specializing in health facilities. We can see it is basically in a big range-bound consolidation for the last several years, and not a riskless range. If you were to have tried to play a breakout, the stock has moved as much as $10 down within this range. Many of these real estate investment trusts, as we said, can be sensitive to rising interest rates. That probably explains some of this volume selling here, but I don't see anything that I want to play here in any way, shape, or form. O&Oak is in the energy transportation space, specifically owns a series of pipelines throughout the United States. This has certainly been a good place to be since energy bottomed back in 2016, and we see this tremendous move up with a predictable period of consolidation. We see this big buying spike here, a selling spike there that really went nowhere, and we're still sort of range bound. I don't see a play on this at this time. We mentioned Palo Alto Networks as one of two cybersecurity firms we follow, the other being FireEye, and that we've been somewhat frustrated as intermittent holders of these stocks that they really haven't gained much traction over the last year or two, despite such a strong degree of discussion of cybersecurity risks in the lay press, on the news, etc., and even with respect to the election. You kind of see here a similar thing to what we were seeing with FireEye. You got this big range-bound area here, what appeared to be a breakdown here, where I'm sure many people thought to go short and they were sprung out below this low, only to see buying come in and a really nice move up. This is a very, very difficult stock to trade. You can see the range of these bars. Earnings are very difficult, again, as we said, with FireEye. This is one to think about for a long-term hold if and when you see the uptrend resume. We're looking now at the chart of Pepsi. We see this consolidation range back in the later half of 2016, a breakout, and we talk about the concept that many stocks will retest the area they broke out. Well, look how long it took for that to happen, and yet it did happen. You see in early 2017 the breakout. We move from the low hundreds all the way up into the 1-teens or so before we fall back all the way down here back early fall or so on very high volume that was clearly climactic with this big bar and a finish up near the top of this price bar. And then the stock has moved up from there, and we see some buying coming in here. Now, in this past week, we see a pretty significant selling volume bar and a finish that was relatively low. So we were starting to see if we could break out above this consolidation area here, and we have failed, at least for the moment. I would say if we can see the week close above this area, we could be looking at another significant move up after this considerable period of about 6 months of consolidation. So this one warrants watching, and you should look on the daily chart for signs of a good entry point. We talked about the pharmaceuticals. This is a somewhat healthier looking chart of Pfizer compared to some of its peers. We see an attempt to break out here above this prior high here. It looks like it's going to go, and we're dropped back down. The move down was on relatively low volume. There's, as you can see down here, there's a high finish to this bar where we came back down here and then finished here, and then we've moved up. Looked like things were ready to go, and this was actually a very nice looking chart in here. And then suddenly we had this big move down again this past week, although the finish is well off the bottom as signaled by this right-sided notch there. This would be one again where you're seeing this consolidation, perhaps an effort to absorb right around this prior high. And if you see a finish up in this 37 area, this may be a very attractive entry point. Procter & Gamble, another one of the big consumer staple stocks and a great dividend payer for so many years. And again, we see the sort of volatile price action in fairly short term for these types of stocks, where the up, the down, fairly rapid cycles on these stocks that make them hard to utilize as medium-term trading vehicles. I don't see especially a good play here right now at this time. Philip Morris, the cigarette company, off again another great dividend-paying stock. Here again you see somewhat of a pattern we've seen on prior charts, this long period of consolidation in 2016, the move down just before the election, sort of a false breakdown. And this is where when people get shaken out like this, there's really a short squeeze where the shorts are forced to buy back their shares, and it really aggressively pushes the price out to a new high. You see after this extended move, a period of consolidation, a weaker move up, some more consolidation, and then a breakdown here. It's kind of hard to tell where this is headed, although one could certainly say we never really came back and tested the breakout, and here's where we are. So we did see some buying come in here in the last couple of weeks. I think if we could see the stock closed, say, above 110 or so, there may be a really nice upside target here, but we're not quite there yet. The NASDAQ chart illustrates some nice things about just how hard it's been to look for opportunities to get into this market. This is the QQQ weekly chart, and you can see how often we've been overbought during the course of the year and really never gone below much in the way of 60 on RSI 14. And so you're thinking to yourself, I just want a pullback so I can get in. And the ETF just grinds slowly higher over many months, not really giving you that pullback you're looking for. There was one there that touched the longer term moving average here, the 20-week moving average. There was one here and one here, but you really haven't gotten that again over the past 2 months or so. And so you can see, again, if you draw a trend line for the upper part of the channel here to here to here, there's maybe a little bit of room here to go. We are in the seasonally favorable period, but it's tough. You're extended again away from the moving average, and even if we ride up into a new high over the next several weeks with the famous Santa Claus rally, one would expect at some point we're going to have some consolidation or pullback. Rogers Communication is essentially the Verizon of Canada. It is a very nice dividend-paying stock and a great company. I think this chart nicely illustrates you have the upper part of the up channel here to here to here, and we've bounced against that several times, and then a period of consolidation. It looks overbought, and we have a breakdown here that has kind of coincided with the move down in other telecommunications across the globe. We're looking again at a period of consolidation after this nice move up. And just because we're starting to get some selling here, it remains to be seen whether this is a fake out or not. We are getting closer to where you could draw a trend line down below here. And if we see a sign of strength, this stock is certainly in an uptrend. It's a good company, and we might find a nice point of entry, but it's not here right now with the selling the past couple of weeks, the poor finish on Friday denoted by the right notch here of this weekly bar, and patience will be a virtue here. Transocean, which is related to the oil drilling industry, has been in a long-term downtrend for several years now, with a significant and very volatile consolidation over the past year and a half or so. We can see it look like a false breakout there, only to have a shakeout there. And what you often see before stocks enter a new uptrend is this kind of pattern where there's been this long consolidation. It appears to break out. People jump in with 2 feet, only to be shaken out and completely demoralized. It goes slightly below this level in a spring, and then that next move, it takes off. Now, we haven't seen that quite yet here on the weekly chart, but that could be indeed what is happening. This is not a stock for the faint of heart. If you get a 5 to 10% move in it, as we did a few weeks back, that is a good time to take a profit. This one always comes back to earth and is very tricky. Rio Tinto is another stock in the mining group. Again, very challenging to trade. We see that it got up near the top area of this upper line of the trend channel, a period of consolidation, a retest of this longer-term 20-week moving average, and it's been chopping around quite hard with really no clear next direction. Although certainly, again, as long as the trend remains intact, you are always wise to follow the trend in your trading decisions. Starbucks is a chart over the last few days to weeks we have liked quite a bit in other time frames. One thing you note here is this tremendous volume bar that is price bar that is associated with very high down volume that finished low, but there was really no progress or follow through here, a little bit of a fake out here, and then we've climbed back up. I think if we could see this stay right above this 59 or so area for a few days, I think this chart is starting to turn. And this represents a significant opportunity for upside. One to watch closely this week. And I would say if you could find that 59 and change position on a close, I would jump in and maybe throw your stop down below a couple weeks ago where price touched down here slightly below 56. AT&T, another telecommunications stock. We talked about with Rogers. We see this move down, except AT&T seemed to lead Rogers in this vein and has already shown some recovery. The spring down below this area. The one word of caution is that there was significant selling volume here, but there seems to be an opportunity here potentially if we see the price above this 37 and change area. I would actually say maybe almost 38 would be where if I could see a close there, I think this has a shot to keep moving up. The clever stock ticker TAP, which represents the stock of Molson Coors Brewing Company, really had a nice run back 2015, 2016 from the 60s up into the 110 area, and then it's really had a very ugly path downward since that time. There's really not much buying volume going on in here. Really no reason to say it's a point in time to buy unless you were interested in the dividend. Certainly beer drinking is here to stay and a good source of profits and dividend payments. But we would recommend here, although it is oversold, again, just because something's oversold, especially in a downtrend, it can become more oversold. And really, you need to find significant strength, some significant buying volume to come in that suggests that institutions are buying. And that is the point that you want to jump on. I don't think we're here yet. TD Bank has been one of our favorites for a long time, and we did a somewhat similar video several years ago, back when it was at a much more opportune price. This is obviously a Canada-based bank. So again, a similar pattern. This consolidation here, a nice move up for many, many months, but still they need to come down and retest this level, which it successfully does. Some buying volume comes in. This selling here leads to no progress and then a breakout. This would have been a really nice point in time to buy this on the breakout above this level. And then we've somewhat grinded higher. I would wait for a significant amount of consolidation and blowing off of steam before I would go in at this point. The stock of T. Rowe Price is another nice example. This long period of consolidation for a year and a half. And then really what you see is efforts to sell here, high volume, not much progress. Pretty good volume there, no progress whatsoever. The stock really doesn't budge. And then the buying volume starts to come in. What's been hard, if you didn't buy it on this breakout, where significant volume came in, you really haven't gotten much of a second chance. A little consolidation there, a little consolidation here. The stock is quite extended, and we think we would wait for a very long period of consolidation or a deep pullback before considering making a trade on this stock. USO is an exchange-traded fund for oil. It is not a good buy and hold option due to the structure of how it tries to match the moves in oil prices. It is also a very challenging trading vehicle. You can see quite a bit of volatility just in a few weeks, how aggressively this exchange-traded fund can move, as does the oil futures component. So here we see sort of this very wide-ranging consolidation since a climactic bottom in 2016. where there was tremendously bad sentiment and a little bit of a shakeout here with a spring, and the stock moves up again towards the top of the range and is stalling. The thing that's hard here, even though my sense is maybe the longer term trend has changed, I'm sure people thought that here, they thought that here. This thing can move in a hurry. It's not my favorite thing to trade or to buy and hold, and therefore I'm merely just pointing out some features of the chart of what happened and not recommending that you do anything with this. Certainly when considering something like a Chevron, a Transocean, or an ExxonMobil, one should be aware of what the appearance technically is of oil itself, as those stocks will move in tandem, usually with those, because their price is so directly tied to the price of the commodity. Ventus is another real estate investment trust involved in the healthcare industry. Again, very difficult to trade, pays a nice dividend. Nothing especially bullish or bearish about where the stock is at this point. There was an effort to sell it off right before the election, and again, it recovered nicely and is kind of in a tight trading range here. You would be best advised to try to pick it up in the lower end of the range and see if it holds that range rather than trying to play a breakout as these have failed previously. Again, Verizon Communications representing the telecommunications space, for which we've seen several charts in the last few minutes. A very wide trading range since earlier in 2016. This is again a stock where the volatility suggests you're better off trying to figure out whether it'll hold the bottom of the range rather than trying to play the breakout. Although I will say here, I like several features of this chart. You've got this level here and this level here. We go down in early 2017 and spring both those areas, surely shaking out people who had placed the stops. We move up, we pull back as a retest, we break down, again surprising the people who placed their stop here, and now we've moved aggressively higher. So I think there is some opportunity here for this stock to actually break out to the upside and go higher. I do like the high volume here, but I would play this very safe if you're playing it for a trade rather than to hold it for the dividend and keep your stop relatively tight. Wells Fargo is a stock which had previously represented a very well-respected company. Obviously, there's been lots of news over the last few years regarding some very shady practices. It has hurt the stock price and made it somewhat challenging to hold, as even when the stock has recovered nice technically, there seems to be another shoe that drops. That being said, I do like the appearance of this chart quite a bit. You see the spring here of these two lows. This would have been a nice place to gain entry. You see a pullback here, again a breakout here, and you're breaking to a new high. I wouldn't have a big problem with placing a stop either below that bar, and on a favorable appearance of a daily bar during the course of this week. If we remain above this level, going ahead and taking a shot at this. I think this has significant room to run here on RSI 14. The financials seem to be breaking out to the upside in general, and this chart seemingly has a little less resistance than we've seen on other charts as well. So I think there is a play to be made here, obviously with good risk management. We always stress we're not trying to be fortune tellers here. I don't know if Wells Fargo stock is going up or down. What I do know is I see points where I can place my stop with small losses, and I think there's potential here after this period of consolidation. Usually after this long a period of consolidation, the move out of it is quite explosive. We saw that here, period of consolidation, and the move out of it goes all the way up to here. I think sort of a similar thing, opportunity right in here, you might want to take a shot at it. Walmart for several years had been sort of a dull and boring stock, and certainly even wore me down several times when I tried to play it. But it has been anything but since early 2017. Here we see the spring of this level right there, where we probably had some people have their stops hit, and then slowly the buying comes in. Some significant volume on the sell side came in here, but really no further downward progress, a little bit of a spring there, and then buying came back in here, a consolidation, a retest. Several opportunities actually. Again, we expect on the breakout for a retest here, you got it. You saw buying volume come back in. That was an opportunity down in the low 80s. You have this consolidation here, a breakout here on volume, again another opportunity, although I would have liked to see some consolidation and a return to the longer term moving average of 20 weeks here. I would say the issue you have again, which we focused on somewhat today, is here's your even number. Now, if you saw the stock here at 85 and you thought it was going to go up, where would you have said the likely stall is? These even numbers are very psychologically important. People think to sell around them, creating resistance. And lo and behold, we almost exactly hit 100 on this bar 4 weeks ago. And now we're in a tight consolidation pattern. There's nothing overtly bearish about this chart. In fact, if we consolidate here for a bit, blow off some steam, it may continue running higher. It's not a place I would look to go long. This was much better. You had just retouched the moving average. You broke out in here. There was surely a really nice opportunity on the daily chart to take this in progress of this bar and ride this up nearly 20 points. So it may consolidate here and go higher. I think, again, as we've talked about on other charts, even if it takes many months, you might look to see if you could get a pullback into this breakout area, and then it would take another run into the 100 area. We'll finish up our analysis of ExxonMobil's weekly chart. And here we see basically some chopping around in a fairly wide price range over a period of many, many months, really the last year or so or more. So here you see something that is getting interesting to me, in that you have sort of this, looks like it might break out, frustration of the people who tried to play that, and a really nasty decline to here, which represents a spring of all these, anyone who put their stop below these levels here on buying got shaken out, and then buying volume starts to come in. A little pullback again to test moving averages, and we're moving back up. Now, you're going to meet a lot of resistance in here. There was a decent amount of volume this week on ExxonMobil. But I think if you could see this start to break out with a close on the daily of around here, this would be worth taking a shot. You had sort of this shakeout here, and then the move, you may be catching just the second wave of this move. And the resistance here is still another $4 or $5 higher. So with a stop maybe down around here, below this price action there. So ExxonMobil is one we ought to watch closely this week as well. Now, early in the video, I had promised the potential to look at daily charts. I think in view of the depth in which we've reviewed the market, various things that we look at to indicate market strength, as well as the amount of time we've spent on the weekly charts, we're going to conclude our weekly review right here. We will certainly review some of the charts that we thought were most promising over the next several days in individual videos and chart posts on Facebook, YouTube, and in other places. And we hope that you are enjoying what we're doing, and we welcome your feedback tremendously. Period. Please tell your